Ask a person on the street what profit is, and they will likely describe the extra cash left over at the end of the year, the surplus that gets swept into an executive's bank account. We tend to picture it as a passive reward, a prize for winning at business, driven by greed rather than necessity. Management consultant Peter F. Drucker looked past this moral framing to address the functional requirement of a bottom line. Drucker argued that a business must achieve sufficient profits to cover the inherent risks of economic activity and therefore avoid total loss. When we define these margins as a survival mechanism against risk, profit moves from being a trophy of success to a prerequisite for endurance. The pursuit of revenue becomes a matter of basic viability. Profit acts as a dynamic multi-tool that performs 5 very specific jobs, shifting its exact purpose as a company matures. Looking at this structural breakdown of business scope, we see those 5 functions clearly mapped out. Profit handles survival, growth, and expansion, the reward for risk-bearing, the measure of efficiency, and finally, goodwill and reputation. An economic system has to hit every single one of these marks. If a business fails to utilize returns across these 5 categories, the entire operation eventually collapses. On day 1, a new business is incredibly fragile. There is no legacy, no safety net, and survival is the only metric that matters. This initiates phase 1. Entrepreneurs engage in trade to secure a basic livelihood. People have bills to pay and needs to satisfy, meaning no one can sustain endless labor without earning a return. That baseline requirement for survival ties directly into phase 2, the reward for risk-bearing. Starting a venture forces an entrepreneur to absorb massive personal and financial exposure. Early operations often run at a severe loss. What keeps the doors open during this initial dip is the psychological and financial assumption of future profit. The founders operate assuming those returns will eventually materialize. Without the promise of that specific risk premium, the personal cost of failure would outweigh any potential reward, deterring individuals from entering the market in the first place. Once a company survives that initial gauntlet, it stabilizes into an established entity looking to scale. Here, profit takes on phase 3, fueling growth and expansion. The returns physically transform into the capital required to diversify product lines and reinvest in infrastructure. As point 4 outlines, profit evolves into a measure of efficiency. It acts as an objective index, where higher margins indicate competent management. Panning down to point 5 reveals goodwill and reputation. Proving efficiency inherently builds strong market standing. Companies weaponize that hard-won reputation to raise external loans, obtain credit, and secure the institutional funding needed for massive scale. The nature of the money changes. It goes from a psychological shield against early ruin to the undeniable mathematical proof required by banks and investors. Zooming out to look at a fully actualized business operating at maximum capacity, we stop seeing isolated phases. Survival, risk, growth, efficiency, and reputation synthesize into a single continuous loop. Each function generates the exact momentum required to feed the next. If you remove the incentive for risk or fail to achieve baseline efficiency, the entire growth cycle abruptly shatters. Profit serves as the requisite fuel for every stage of the business life cycle. It is the oxygen of the economic system. There is an important caveat at the end of the source material. The scope of a business should never be restricted solely to earning those returns. Think of it exactly like oxygen for a human being. You absolutely need it to survive and to grow, but the act of breathing is not the ultimate purpose of your life. Understanding profit means looking past the hoard and seeing it as the fundamental biological requirement that allows a business to exist and eventually to serve society.